Hey everyone, Tom Gentile. Welcome to Tom's Trading Room. Forget about what's going on with coronavirus for a moment. Forget about the election that's happening next week. I want to concentrate on earnings, and I want to show you how I approach earnings, buying before the report and selling right before the report. So, let's get to work. Hey everyone, Tom Gentile. Welcome to Tom's Trading Room, where here, you know what we do. We spot opportunities and we create alternative risk trades other than simply buying and holding stocks. Do me a favor right now, hit that like button, show me some love. It helps support the channel. Also, subscribing to the channel will get you these videos as soon as they're uploaded. Okay, October 26th, 2020. It's National Pumpkin Day. But I want to make this National Let's Make Some Money Day, so let's get into my podcasting room and let's get started. Okay, so let's first start out by talking about earnings and why it seems to be frustrating for most people when profitable for a few. And the reasons why is because most people approach earnings as trying to pick the price of a stock that goes through earnings. And the problem is it's very hard to predict future prices from earnings announcements because, again, good news can be bad for the stock market and bad news can be good. You know, if you take a look, like I said, good news doesn't always lead to higher stock market prices. And here's an example of a stock that had 4 positive earnings in the past, and yet the stock still went down. So, how do we make it more profitable on the side? How do we get on the side where the few are profitable? Well, we use something called the power of implied volatility. Implied volatility is really the angst of the markets, and it's equated into options prices. So this is a chart that I like to look at right here, where we see these red lines popping up and coming down before and after earnings, popping up before earnings and coming down. And again, and looking for that heartbeat pattern that you see there that's going on. And it really does look like that. And in this example, we saw in all 4 occasions the market or the implied volatility of the options spiking up. That means time premium went into options prior to the earnings premium, prior to the announcement. And then the same thing, Amazon, same exact thing. There are stocks that have a characteristic or that have characteristics of moving higher ahead of earnings and dropping right after earnings. All right? A pop followed by a drop, and that seems to be the case. So what do we want to do? What we want to do is we want to be in green light before the earnings and out right before the earnings, because it's easier to make money on the implied volatility going higher with a smaller stock price than with the implied volatility dropping, and who knows where the stock's going to go after that. So this is the pattern that we look for. In before earnings, out right before earnings. In before earnings, and out right before earnings. So let's take a look at what's happening in the next week. And to do that, I'm going to surf back on over to my website. And I'm looking at something called earnings effects. And so what we're looking for is we're going to look at the S&P 500 optional stocks. And I want to look at 2 things. I want to look at the best price change before earnings. And I can do that and I can actually click. And it's going to take a few seconds for the data to go forth and find those stocks which have the best price changes the week prior to earnings. And what we find is this. We find stocks like Gap, EOG Resources, Tapestry, Discovery Communications. Well, they all move ahead of earnings. And for instance, for Gap, moved 24% week prior. The quarter before that moved 37% week prior. And the quarter before that went 29% down and 11% down. Well, what we're going to look for is we're going to look for stocks that move in the same direction, up or down, when it comes to price. But that's not what I'm looking for. What I'm also looking for is those stocks that had the best implied volatility change before earnings. Remember green light, red light? We want to find those stocks whose options increased in value before the earnings. And we're going to go back and look at that as well. So I want to do a search on that. So the counter's going. Won't take too long to get this information. All right, so let's take a look and see what stocks have options that are moving the most before earnings. Well, look what's been going on. Walt Disney has had option premiums increase 28%, 54%, 65%, 19%. Look at First Republic. Look at those double-digit gains in the option premium. All right, Sempra Energy, General Motors, etc., and the list goes on and on. Wow, I wonder if I could find a couple stocks that have stock prices that consistently go up with options that consistently go up, and or prices that consistently go down before their earnings while their option premiums too go higher in value. Well, just so happens we have that. And I've ranked out those top two stocks. One is a bear and one is a bull. Chevron is showing us that put options typically go higher in value, and for 4 of the last 4 earnings cycles, it has done just that. PayPal Holdings, well, their stock tends to go higher and their call options tend to go higher too as we go into earnings. And so both of these have earnings coming up, Chevron in the next couple days, PayPal in the next week. And so let's take a look at each of these. And we'll take a look at, again, their stock prices. So Chevron's going to be CVX. So I'm going to come in and I'm going to look at the stock chart on CVX. Let's do that right now. And from here, what I want to do is, again, now, I'm not looking at, let's go back 90 days. And let's update this. Now, if you take a look here, you can see that this stock has dropped in value, but I don't care about what it's doing in the last 90 days. I only care what it's doing the week leading up to earnings. And if the week leading up to earnings, in this case, it's been dropping, and the last 4 quarters it's been dropping, that's good because that means put prices have gone up in value before the earnings come out. Look what happened after earnings. It went higher the days after. I don't care about what happens after earnings. I only wanted to take this trade the week prior to earnings. And look what's happening. We're coming down on Chevron. It's coming down to some lows. And earnings are coming out in the next 4 days. So based on historical probability, this stock should drop over the next 4 days. Again, the symbol is CVX. What kind of options are we talking about with CVX? Well, if you look here, these are the OCC 3070 puts, and they're trading for $1.39. So you're talking about $139 for this particular trade, all right, going into the next few days. And this has 4 days to expiration. But again, I want to be out right before the earnings announcement, all right? So what do I know about the earnings announcement of Chevron? Well, I know that they announced, and this is not for sure, but it tells me that they're likely to announce before market open, that's BMO, on Friday, October 30th. Now let's take a look at PayPal. PayPal's the call option. PayPal's calls tend to go higher in value. So if we were to go look at a stock chart of PayPal, okay, PPYL, and click update. And did I get that wrong? Let's go take a look. Hey, it happens. I'm not going to edit this. All right. PYPL. Okay, there's my concern. PYPL. And then click there. Now I'm getting a chart of PayPal. Now look what happens with PayPal. It tends to go higher the week prior to earnings as well. This is before earnings. This was the day after earnings. Again, I don't care what it does after earnings. I only want to take advantage of what happens that week prior to earnings. All right, so we know it goes higher. We also know, look at the red line, the implied volatility. This is the option premium. It goes higher as well. Now, take that information and I look at a PayPal option graph and I can see PayPal's option is going to cost a little bit more. It's a more expensive stock, right? So we know that it's a $200 stock, where Chevron was only $70, so it's going to have a more expensive option. Also, the implied volatility in these options is much more expensive than oil and energy because this is technology. But again, what are we looking for? We're looking at an example of an at-the-money call option. We do not want to hold it. This one has 11 days to expiration. I don't want to hold it all the way to expiration. I only want to hold it right before the earnings come out. So if I go back and look and see when those earnings are coming out, well, those earnings are due to come out after market close on 11/2. That's November 2nd. So I want to be out right before the close on November 2nd. All right? So that gives me a lot of information to go by. Now, do I care about what the overall market's doing? Not necessarily. All I care about is I see a pattern here that's repeated itself, and I would like to see it repeat itself once more. In summary, you just got a glimpse of how I trade earnings. And as we're in the sweet spot, I expect earnings to continue to deliver opportunities well into mid-November. Also, keep in mind, what I'm doing is I'm buying before the news and selling right before the news, looking at call options to be bullish, put options to be bearish on both price and implied volatility patterns. And finally, no strategy is 100% effective. Just keep that in mind and see if you can put this one to use. Thanks for joining. We'll see you soon. Bye now.